Let us discuss some problems on the binomial tree. We will first solve some problems on one period European call option pricing and slowly graduate to two and three stage or three period European and American option pricing. So the price of a European call option with the following parameters are available. The current stock price S0 is 20, up factor U 1.1, down factor D 0.9, risk-free rate 5%, and time to expiration is 1 year. The strike price K is 21. So the European call option has been executed at a strike price of 21 and the current stock price is 20. This is a call option. So this option is in the money now because the stock price S0 is less than the strike price 21. So it is out of the money now. Since the current stock price 20 is less than the current strike price 21 and it is an European call option, the option is presently out of the money. Now let us see how do we calculate it. What is the first step to calculate? You have to calculate the terminal stock prices. So how do we do it? So the first step is you have to calculate the SU, that is the probability of an up move. So S0 into U, they have already given what is the value of U, which is 1.1. So you get 22 and HD as 18. Simple calculation, I will not explain it. And in step 2, what are we going to do? We are going to determine the option payoffs. So for a call option with a strike price of 21, FU will be max of SU minus K. What is SU here? 22 minus K. What is the strike price? 21 comma 0. So it is the max of this. So the max of 22 minus 20 is 1. So the value of the option FU after an up move of 1.1 is 1. Similarly, the value of the option when the down move has happened is 0. So then the third step is we calculate the risk neutral probability. So what is the risk neutral probability formula? We should already know that P is given by e to the power of RT minus D divided by U minus D. So when we substitute the value of the risk-free rate, time period and up move and down move, then you get the P as 0.756. So what is the step 4? You compute the option price using the risk neutral valuation formula. So what is the initial option price, which is equal to e to the power of minus R into delta T multiplied by P probability of up move and into the option price FU plus 1 minus P into FD. So what is the value of the option? The value of the option is 0.713. So this is the price of the call option in a one period European call option. Now how do we verify it? So we can calculate the hedge ratio using the formula. This is called as delta. Delta is nothing but change in the price of the option with respect to the change in the price of the underlying. So here FU minus FD is change in the price of the option divided by S0U minus S0D is nothing but the change in the price of the underlying. So if we substitute these values, what do we get? We get the value of the delta as 0.25. So what does it mean? In case if you want to have a portfolio that will not vary whether the stock is going to move up or stock is going to move down, that is the underlying is going to move up or the underlying going to move down, then if you are holding an option, European call option, then you have to have 0.25 shares for each option you are going to sell to create a riskless hedge. So delta will give you the value of the riskless hedge you have to undertake for a combination of the underlying and the option which you are holding in order to hedge the portfolio. So suppose if you are holding 0.25 shares of an underlying, then in that case you have to write one call option in order to hedge the underlying value of 0.25 shares. So if you sell one European call option with a combination of 0.25 shares, the portfolio value will never change whether the option price and the underlying price is going to move up or it is going to move down. So how do we interpret it? The call option is priced at 72 paisa. So how much is this 72 paisa, which is approximately 3.6% of the underlying stock price. What is the underlying stock price? 20, right? So this relatively low value, see, the value of the option is very low. It is just 3.6% of the value of the underlying. So this reflects that the option is slightly out of the money. So when I started the question, I said that since the current stock price is less than the strike price, the option is out of the money. Since the option is out of the money, hence the option price will always be less, and this option has only a 75.6% risk neutral probability of finishing in the money. In the money means the stock price should go above the strike price of 21. Now let us take another example. Here we will do a 2-period European put option. Here we are taking a put option. Previously we used call option. So price a European put option with the following parameters. So what are the parameters? Current stock price is 100 rupees. Up factor, that is the probability of moving up, is 1.2, that is 20%, and down move is 0.8, that is down move is also minus 20%, and risk free rate is 4% per annum. And the option has, this European put option has a time period of 2 years. It's a long period of time for this option, and the number of periods is n is equal to 2. So when n is equal to 2, you will have a 2-step binomial tree. What is the strike price K? The strike price is 100. What is the current stock price? 100. So the current stock price and the strike price are equal. Hence, it is the option you can generally say is at the money option. Whenever the current stock price and the strike price are equal, then you call the option as the option is at the money option. When the current stock price is greater than the strike price in a call option, then you call it is in the money. If the current stock price is less than the strike price in a call option, then you say it is out of the money. Here, since we are having an European put option, if the current stock price is less than the strike price, it will be in the money. And if the current stock price is greater than the strike price, it will be out of the money. And if the current stock price 100 is equal to the strike price 100, then the option is at the money option. Let us see how do we construct this binomial tree. So the stock price, initial stock price S0 is equal to 100. So let us take the first period T is equal to 1, and then upstate of S0U is what? 100 into 1.2, it becomes 120, and downstate is 100 into 0.8, it becomes 80. At the second step, where T is equal to 2, the upstate S0 into it becomes U square, it becomes 120 into again an up move of 20% of 120% of 120 becomes 144, and it has down moved. So SUUD is equal to 96, because 80 into 1.2 will be 96. Now if you consider the complete down move, that is S0 into D square, it is 80% of 80, which becomes 64. Okay, now we will calculate the terminal payoffs. See what has happened. This is the binomial tree which we just calculated in our previous slide. So when the initial stock price is 100, when the probability of up move is 120%, because the u value is 1.2, so you get the up move value as S11 as 120. So when the same is moving down by 20%, that is 100 into 0.8, it becomes 80%. Now S11 after the first stage of the move, this stock price of 120 can again move up or it can move down by 20%. So when 120 moves up by 20%, it becomes 144, and this 120 moves up down by 20%, it becomes 120 into 0.8, it becomes 96. Now here that is S10, this also has an option to move up by 20% and move down by 20%. So when 80 moves up by 20%, you have the value 80 into 12, which is nothing but the 96. And if this 80 moves down, then you have the value S20 is equal to 64. Now let us calculate the terminal payoff. So for a put option with a strike price K is equal to 100, at this, that is 144, see these are all the terminal values of the binomial tree. Okay, now if we want to calculate the terminal values of this binomial tree, that is the option prices at these particular values of the underlying, see the underlying value S22 is 144, S21 is 96, and S20 is 64. But now you have to calculate the option price also. So how do we calculate it? It is P22. See, the price P22 will be max of strike price minus S0 U square. S0 U square is 144. So which is max of 100 minus 144 comma 0. Maximum of this or this. Here this is 100 minus 144 is minus 44. So 0 is greater than minus. So hence the value will become 0 at this point. Okay, the option value. Now at this point, that is S0UD, when the value of the underlying is 96 rupees, it is max of K minus S0UD or 0, which is nothing but 100 minus 96 or 0, where 100 minus 96 is 4. See, 4 is greater than 0, as a result of which the value will become 4. At S0D square, where this is the S0D square, so P20 will be K minus S0D square is nothing but 100 minus 64. Okay, 100 minus 64 is 36. So here the P20 will become 36. Now we have to calculate in the step 2 the risk neutral probability. So what is the risk neutral probability? The time step is what? Small h is equal to capital T divided by n, where number of total expiration of the option is 2 years and the number of periods are 2, so it becomes 1 year. So we calculate P as e to the power of r into capital T minus d divided by u minus d, which is nothing but the probability, that is risk neutral probability, as 0.6. So P is 0.6 and 1 minus P is 0.4. Now we have calculated these values, which which we just explained. I have put it here in the form of a diagram. So P22 is max of 100 minus 144, 0. Here P21 is max of 100 minus 96, 04, and P20 is max of 100 minus 36. Now we have to do the backward induction in order to get the value of P11, P10, and P00. So what is the continuation value you should use? The formula for backward induction is, so the formula for backward induction is, at the up node, that is point P11, it is e to the power of minus RH into P into probability of 22 plus 1 minus P into probability of 21. So what is the value? E to the power of minus 0.04 into 1 into 0.6, that is the probability, risk neutral probability P, which we calculated as 0.6, into what is the value of P22 here? It is 0. So value of P22 is 0 plus 1 minus P is what? 1 minus 0.6 is 0.4 into What is the value of P21 here? Value of P21 is 4. So you get P11 as 1.54. Now coming to the down node P10 here, again we use the same formula and we will substitute the value of P21, which is 4, and this is not P21, this is P20 as 36. So here you get the value of P10 as 16.13. And finally, the initial value of P00 is e to the power of minus RH into P into P11, it is 1.54, and P10 is 16.13, which comes to the value of the initial value of the option as 7.1. So what is the strike price? 100. What is the option price? 7.1. So how much percentage is the option price compared to the strike price or the initial price of the underlying? It is 7.1%. So how do we interpret? In this European put option, the value is worth 7 rupees 6 paisa, which is about 7% of the underlying stock price. So how do we interpret this result? So this European put option will give significant protection against the downsides because we are considering the downside as 20%. Okay. So this put option will generally provide a significant protection to the portfolio for any drastic downside movement of the underlying. So how do we verify it? So we can verify our calculation by checking that the implied volatility from our U and D parameter is reasonable. See, implied volatility is nothing but the volatility implied by the underlying. So how do we get the implied volatility of a stock? The implied volatility of a stock is nothing but the historical volatility of a particular stock. So that is being used. Sigma is the volatility. What is the formula for sigma? Which is nothing but log normal of U divided by square root of H. That is the time period, number of time steps, which is nothing but 18.2%. See, 18.2% historical volatility or implied volatility of a stock is quite reasonable. So this is how we verify our result using the binomial mathematical model. Let us take another example to understand the binomial tree calculation. Here what are we using? We are using an American call option with dividends. Now the dividend may be represented as a total amount or it may be represented as dividend yield. Let us see what is going to be given in this problem. What is the problem statement? Price an American call option with the following parameters. So what are the parameter? Current stock price 50, up factor, that is probability of up move is 10% and probability of down move is equally 10%. Risk free interest rate is 3%, and here they have given dividend yield rather than the dividend. So this dividend yield is 2%. So this get reduced from the risk free rate while we are calculating the risk neutral probability. So time to expiration capital T is 1 year. So this American call option with dividend has an expiration of 1 year. Number of periods is how much? 3. So we are going to have a 3-step binomial tree we have to construct. And what is the strike price? 52. See, what is this option? This is an American call option. Okay. So this is basically a call option. So here the current stock price of 50 is less than the strike price of 52. Hence, this American call option is basically an out of the money option. Okay. Now let us see how to analyze this. Here in this question, we have two concepts. We were dealing only with European option. Now you are introducing American call option. What is an American call option? An American call option can be exercised at any point during the tenure of the option contract. That is, if the tenure of the option contract is 1 year, you can exercise the option anytime. Whereas in European option, you can exercise an option only at the end of the time period of the contract. And the second concept which is we have introduced here is dividend yield. See, dividend yield will always get reduced from the risk-free interest rate because dividend yield is the yield or the money received by the person holding the underlying stock. So let us see how to see. As I had explained, we have to calculate three stages. This is stage 1, this is stage 2, and this is stage 3, because small n is 3. It is a 3 period European American call option. Hence we have to calculate the value of the underlying in 3 different stages. So at the initial, the stock price is 50. So if it moves up by 10%, it becomes 55, and if it moves down by 10%, it becomes 45. Again, at this point, that is when S11 has happened, this 55 has again a chance of moving up by another 10%. So if it moves another 10%, it becomes 60.5. That is 55 plus 10% of 55 is 5.5. So 55 plus 5.5 becomes 60.5. And similarly, the probability of down move is minus 10%. So 55 into 0.9, it becomes 49.5. Now, from here, when it has moved down 10%, the value is 0.9 into 50, which is 45. And at this point, it has a probability of up move of 10% and a down move of 10%. So if it moves up by 10%, so 45 plus 10% will become 40 plus 4.5, 45 plus 4.5, which becomes 49.5, and 45 minus 4.5, it becomes 40.5. Now the stock price is here. So again, it has got a probability of 10% to move up and 10% to move down. So if it moves up by another 10%, 60.5 into 1.1 will become 66.5, and 60.5 into 0.9 becomes 54.45. At this node, again this node has a probability of up move of 10% and down move of 10%. So 49.5 into 1.1 will be 54.45, and 49.5 into 0.9 will be 44.45. When you come to S2 0 node, here again this stock price of 40.5 has a probability of up move of 10% and probability of down move of 10%. So 40.5 into 1.1 will be 44.45, and 40.5 into 0.9, I have not written here 0.9, please take that, it becomes 36.45. So at the end of the third stage, the stock price of the underlying will be 66 point, it can be 66.5, it can be 54.45, or it can be 44.45, or it can be 36.45 also. So this is how we have done the calculation. Now we have to calculate the risk neutral probability. What is the formula for the risk neutral probability? Small p is equal to e to the power of small r minus delta. What is delta? It is the dividend yield into h minus d divided by u minus d, which is nothing but the probability is 0.517. That is the probability of up move. The probability of down move will be 1 minus p. You can say 1 minus 0.517. Now you have to build the stock price tree. So I have explained how to build this stock price tree here, and this is the mathematical calculation which is done here. That is 50 into 1.1 will give 50, and 50 into 0.9 will give you 45. So and so on and so forth. I will not explain it. You can just do it on your own. Here again 55. Suppose it comes to S22. S22, what we are doing? 50 into 1.1 into 1.1 gives you 60.5. Now if you want to come through this from here to here, what you do? 50 into 1.1 into 0.9, you get 49.5. Now if you want to come to this step, it is 50 into 0.9, which becomes 45. But if you want to come here through this route, it is 50 into 0.9 into 1.1 will give you 49.5, and so on and so forth. This has all been calculated here. You can just verify these two what I have explained now. Now let us see the terminal values. See, the terminal values is the value of the option at the end of the 3 periods. So what is the formula which we use? The formula which we use is Since it is a American call option, we are going to use the formula max of S minus K. Here what is S? S33, which is 66.5, that is maximum of 66.5 minus the strike price 52 or 0. So 66.5 minus 52 is 14.55. See, 14.55 is greater than 0. So the option value will become 14.55. Now when we come here to the second terminal value, here at C32, it is max of, what is the S value? S32. S32 is 54.45 minus, what is the strike price? 52 comma 0. So what is the max of 54.45 minus 52 comma 0, which is nothing but 2.45 is greater than 0. So we are taking the value 2.45 because we have to take the max of these two. Okay. Similarly, C31 will be 0 because here the value of 44.45 is less than the strike price. As a result, C3 will be 0 and C30 will again be 0. Now, this is what we have calculated here. Whatever I have explained here, I have shown the calculation as max of 66.5 minus 52, which is 14.55, and P32 is max of 54.45 minus 52, it is 2.45. Now we have to do the backward induction with early exercise. Backward induction means we have to find out the value of the second stage of the nodes, option values, and the first stage of the nodes option value. How do we do it? What we have to do at each earlier node is this: we compare the continuation value and the exercise value, and we take the maximum of these two. If the continuation value is higher, we will take that, or if the exercise value is higher, we will take that. So let us do this calculation, how this second and first node values are calculated. So P22, this is P22, will be what? What is the formula? E to the power of minus small r into capital T into P into P33 plus 1 minus P into P32. So what are we doing here? This calculation has already been done, that is e to the power of minus r into capital T. What is e to the power of minus r is 0.1. So e to the power of minus 0.01 into 1. So it becomes 0.99 almost. So here 14.55 into probability of upmove is how much? 0.517, which we calculated using the risk neutral probability P, which we calculated as 0.517, plus probability of down move here C32 is 2.45 into 0.483. So the P22 value comes to 8.62 here. Now P21, similarly we can calculate. P21 is how much? 0.99 into 2.45 into 0.517 plus the probability of down move is 1 minus P, that is 1 minus 0.517 is 0.483 into, what is the value of C31? This is 0. So into 0, which is 1.27. And similarly P20, this one is equal to 0. This one is P20 is equal to 0. Now coming to the first stage, we use these values to get the value of these two. Okay. Now P11 is 0.99 into 8.62 into 0.517 plus 0.483 into 1.27. So you get value of 5. And P10 is equal to 0.99 into 1.26. Where is 1.26? This one into 0.517 plus 0.483 into 0. So you get 0.64. So here the value of P10 is 0.64 and value of P11 is 5.01. Now the value of P0 is same formula we are using, e to the power of minus RT, which becomes 0.99 into 5.01 into probability of up move is 0.517 plus 0.483 into probability of, that is this value P10 is 0.64, so 2.89. Now we have to calculate the backward induction with early exercise also. So for each node we have to calculate the early exercise option. We have calculated the continuation value using this formula here. e to the power of minus r delta t into p into fu plus 1 minus p into fd. So this is the formula which has been used to get all these values. Now you have to calculate the exercise value. Exercise value is same as this formula which we used. Max of 66.5 minus 52. Here also we will use the same value and see what will happen at each node. Now here we can see that at this point, that is the second stage node, max of 60.5 minus what is the strike price, 52, comma 0. So in out of these two, which is the maximum value, 60.5 minus 52 is 8.5. So max of this is 8.5. So if we do early exercise, then the value is 8.5. But if we stay with the European option, the value is 8.62. So we will generally stay with we will not exercise early, because exercising early will give you only 8.5 rupees. Whereas if you hold the option, it will give you 8.62. So if we are considering these two, we will wait for the option to expire till its time value of 1 year. Now coming to this node, S21 node. Here max of 49.5 minus 52 comma 0, it is 0. Here again, if you hold the option, we may get 1 rupees 27 paisa. Whereas if you try to exercise now, you will not get anything. The option will expire worthless here. Similarly, at stage S20, max of 40.5 minus 52 comma 0 is 0. Whereas P2 comma 0 is also 0. So it makes no difference whether if you are if the price is this, it makes no difference whether you are going to exercise the option early or you are going to hold the option, because both the values are equal to 0. Now let us come to this stage. When the option price becomes 55, P11 value is 5.01, whereas this is continuation value and this is the early exercise value, max of 55 minus 52 comma 0, which is nothing but 55 minus 52 is 3, and it is given as 5, it is 3. So what are we going to do? Since early exercise will give you 3 rupees, but if you hold it, you will get 5 rupees. So you are going to hold the option. Similarly, at S10, P10 is equal to 0.64. So max of 45 minus 52 is 0. So if you hold the option till maturity, you will get at least 64 paisa. But if you exercise early, you will get 0 rupees, because the option will expire worthless, because the option price is less than the strike price. Okay. So we will conclude that in this present example, early exercise is not optimal at any node. Why it is not optimal at any node? At any node, continuation value is always higher than the early exercise value. So it makes no sense to exercise this option early, because holding the option till maturity will give you better reward compared to exercising early. Why the option value has become less? Because we are getting dividend yield also. Okay. So the 2% dividend yield reduces the call option value compared to a non-dividend case. So without dividends, the risk neutral probability would have been 0.539 and the option would be worth around approximately 3 rupees 50 paisa. Now let us take hedging delta in a one period model problem. So determine the hedge ratio, very simple. Delta, what is delta? Delta is nothing but change in the option price divided by change in the underlying price. So this is for a one period binomial model with the following information. What is the information given? Option payoff in upstate 5, option payoff in downstate 1, stock price in upstate 110, stock price in downstate 90 rupees. So as I have explained, delta represents the number of shares, the underlying asset that should be held for each option written to create a risk-free position. You should know what is option writing. Okay, if you don't know what is option writing, go back and study what is option writing. Then only you can understand the binomial theorem. Option writing means you will short the option. Okay, so Delta measure, what does delta measure? It measures the sensitivity of the option price with respect to change in the price of the underlying. So as far as the binomial model is concerned, it is nothing but the slope of the line connecting the option values at the up and down nodes, and it is being normalized by the corresponding price difference of the underlying stock. Okay, a perfect hedge, if it is there, it will completely eliminate any risk, and any up move or down move in the stock price will not affect the value of the portfolio if a perfect hedge is done using the option contracts. Here, if we apply the formula, that is change in the portfolio, that is the delta fu minus fd by s0u minus sd, it is 0.2. What does it mean? So a delta of 0.2 is a very low delta, means for each option sold, the seller should purchase 0.2 shares of the underlying stock to create a risk neutral position. What is risk neutral position? Whether the underlying price goes up or underlying price goes down, the value of the portfolio will remain the same. It will not change. That is called as a perfect hedge. Okay, so how do we construct a portfolio? Suppose if a trader writes 100 call options, then he has to hold 20 shares, that is 100 into 0.2, because the delta is 0.2. So 100 options into 0.2, so he has to hold 20 shares of the underlying in order to have a perfect hedge and to ensure that the portfolio is a risk neutral portfolio. Now let us take another example where there is a 3-period European call option pricing. Price a European call option with the following parameters. What are the parameters? Stock price 100, up factor is 10%, that is 1.1, and down factor is again 10%, so it becomes 0.9. Risk free rate is 5%. See, time to expiration here you can see it is a very long expiration time, 3 years, and number of period is 3. So number of periods 3 means you will have to construct a 3-stage binomial tree. And what is the strike price? Is 100. Current stock price is 100, strike price is 100, so the option is an at the money option. So it is quite obvious that for a 3-period model we have 4 possible terminal stock prices. Now let us calculate the parameters. First one, we have to calculate what? You have to calculate the risk neutral probability. What is the formula? Small p is equal to e to the power of rh minus d divided by u minus d. So the probability value will be 0.756. It means the probability of up move of the underlying is 75.6% and down move is somewhere around 24.4% or something like that. That is 1 minus 0.756. Now let us calculate the terminal stock prices, that last 4 terminal stock prices. See, we will start with S0. See, S0 is 100. So if it moves up by 10%, it becomes 110. That is 100 into 1.1. From this node, that is S11, if it again moves up, it has to move up by another 10%. That is 110 into 1.1. So it becomes 121. Again in this node S22, if it has to again move up, it will move up by another 10%, that is 121 into 1.1. So what is the value of S33? It is 133.1. That is what exactly we have calculated here. Okay, 100 into 1.1 3 times. Okay, now if we want to calculate the value of 32 here, okay, what is the value? First we will go through this. 100 into 1.1, it becomes 110. 110 into 1.1, it becomes 121. And 121 into 0.9, because we are moving down here 10%. So 121 into 0.9, it becomes 108.9. But we can reach the same node using another route, that is 100 into 1.1, it becomes 110. 110 into 0.9, it becomes 99, and from 99 it again moves up by 10%, it becomes 108.9. So we can take any route to come to this particular S32 value and you will get the same stock price as 108.9. Similarly, for S31, there are you can use different routes. You can use this route to get 89.1, that is 100 into 1.1 into 0.9 into 0.9, you will get 89.1. Or you can use 100 into 0.9 into 1.1 into 0.9, you will get 89.1. Or you can use 100 into 0.9 into 0.9 into 1.1, you still get 89.1 as the stock price. And finally, S30 is 100 into 0.9 into 0.9 into 0.9. So you get 72.9 as the terminal value of the stock price. So the four terminal values of the stock price is 133.1, 108.9 and 89.1 and 72.9. Now, what are we supposed to find out? We are supposed to find out the terminal option payoffs. So what will be the terminal option payoff with a strike price of 100? For P33, it is max of. What is the option type? It is a call option. So since it is a call option, what will be the formula? Max of SU, that is S33 minus K. S33 minus K, that is K is strike price, that is 133.1 minus 100. So the value of the option at S33 when the stock price is 133.1 is 33.1 rupees. Similarly, here it is at node S32, you have the option price max of 108.9 minus 100 comma 0, either of the two, whichever is max. So rupees 8.9 will be the option price at S32, and the option price at S31 is max of 89.1 minus 100. Obviously 89 minus 100 will be a negative value, so the option value will become 0 here at S31 node. And similarly at S30, the option value will be max of, it is not 81, it is 72.9 minus 100. Please correct it. It is not 81, it is 72.9, because this is the value, right? Here we are using 89.1 and here it should be 72.9. So 72 minus 100 comma 0, what is the max? 0 will be the max, because 72.9 minus 100 will become a negative value. So you will get 0. So we have calculated the option prices for all the terminal stock prices. Now we have to do the backward induction formula. So how do we use the backward induction formula? The backward induction formula is e to the power of minus small r into t into p into the price or option price in the forward node plus 1 minus p into the option price in the forward node. So for node P22, what are the two option prices? 33.1 and 8.9. So the up move is, what is the probability of up move? The probability of up move is 0.756 into 33.1 plus the probability of down move is 1 minus p, that is 1 minus 0.756 is 0.244 into down move is 8 rupees 90 paisa. So the value of P22 is 24.3 here. Similarly, at point, this is not 0.33, please correct it, it is point, this is 0.22 and this is 0.21. See, this is 22 and this is 21. What is the value of 21? So P21 is equal to e to the power of minus 0.05, which is nothing but 6.4. Similarly, at S20, the option value is P20, it is not 33, P20, which is equal to 0. Why it is 0? E to the power of minus 0.05 into 0.756 into 0 plus 0.244 into 0. So at P20, this is P20, please correct it. This is P20, this is P21 and this is P22. Alright. Now coming to the last value, P11, P10 and P0. At t is equal to 1, P11 is how much? 0.756 into 24.3 plus 0.244 into 6.4. So you get rupees 18.96 for this. And for P10, it is e to the power of minus 0.05 into 0.756 into 6.4 plus 0.244 into 0, it is approximately 4 rupees 60 paisa. So at t is equal to 2, that is the initial option price, we use the same formula and we use the value of and we use the value of 18.96 and 4.6 to get the option value at the start as 14 rupees 70 paisa. So here the European call option price of 14.7 is about 14.7% of the current stock price. What is the current stock price? 100 rupees. So 14.7 means option price of 14.7 means it is 14.7% of the stock price. So this is a very high value. Why it is a high value? Because the expiration time is very long of 3 years, as a result of which the option price will always remain high. And the option is also is at the money, where the strike price is equal to the current price of the stock. Okay, let us analyze another problem. This problem involves something called as barrier option, and we are going to price the barrier option using the binomial tree. We are supposed to price a knockout put option. What is the option type? It is a put option and it is a knockout put option. We will analyze what is knockout put option means. And let us understand the parameters first. So the current stock price is 100, up factor is 1.1, down factor is 0.9, risk-free interest rate is 4% per annum, and time to expiration is 1 year. And the number of periods is 2. So, and the strike price K is 95. Now the most important point comes knockout barrier. What is knockout barrier? Knockout barrier means as soon as the option price reach rupees 90, the option becomes worthless. Why? Because we have taken first of all a put option, and any price decline to 90 will make the option worthless. Okay, now what are the key concepts of the barrier option? Barrier options are basically dependent upon the path the option price takes. It does not depend essentially on the final asset price. See, here we are using a European option. So European option, it means to say that it should be, we should be considering only the at the end of the contract. But once a barrier option is introduced, the option is dependent on the path but not on the final value of the option price. So as soon as the option price crosses a certain threshold value, then the option either comes into existence or it will get crashed out or it will become worthless. So there are two types. One is the knockout option. Knockout option means the option will cease to exist if the asset price touches the barrier. Here, what is the barrier given? 90 rupees. As soon as the stock price reaches 90 rupees, the option on that particular stock price becomes worthless. Knock-in options are just the opposite. So in case of a knock-in option, as soon as the stock price reaches a particular threshold value, let us consider 90 in this case. If it would have been a knock-in option, then the option would have come into existence once the option price touches rupees 90. So that is how there is a difference between a knockout option and knock-in option. So let us analyze the binomial tree, how to calculate the prices at various option levels. So at S0, the current stock price is given at 100. So the up move is 1.1 and down move is 0.9. It means the stock price can go up by 1.1 or it can go down by 0.9. So if it goes up by 1.1, the stock price at S11, this is the next level, at this particular node it becomes 110. And if it goes down by 10%, so the stock price at S10 node will become 90 rupees. Similarly, here at this particular node, this stock price has two paths. The first path is it can move up by 10%, that is 1.1 into 110, which gives S S22 is 121, and this option price 110 can move down also by 10%. So 110 into 0.9 will become 99 at the node S2.21, that is 21 node. Now this node S10 has again two different paths. It can either go up by 10%, so 90 into 1.1 will become 99, or it can go down by 10%, so it becomes S20 becomes 81. Here S22, S21 and S20 are all the terminal stock prices. Since we are considering a two-step binomial tree, these are the terminal prices of the stock. So this is what is been explained here. I have just explained it here in the tree. Mathematically it is given S11 is 100 into 1.1, 110. S10 is 100 into 0.9. Similarly S22, S21 and S20 can be similarly calculated. Suppose for S22 what are you going to do? You are going to multiply 100 by 1.1 into 1.1. So that will become 121. For S21 you multiply 100 by 1.1 and 0.9, or 0.9 into 1.1, that will also give the same answer 99. And for S20 you multiply 100 by 0.9 and again by 0.9 to get a value of 81. Now the second step is to identify the barrier crossings. So in order to identify barrier crossing, what is the barrier value? The barrier value is ₹90. So any time when the option price reaches 90, the option gets knocked out. It becomes worthless. So where are the points at which the option can get knocked down? It can get knocked down at S10 and it can get knocked down at S20. So these are the two places at which the price of an option can get knocked out. So this is a very important component, that as soon as the price reaches this point, the option is getting knocked out. So now let us calculate the terminal value. At t is equal to 1, S10, that is here it touches the barrier. At t is equal to 2, S20, where is S20? Here. 81. So here also 81 is below the barrier value of 90. So these are the two places at which the option can become worthless, or the option can get knocked out. So any path that goes through these nodes will lead to the option getting knocked out. Very simple. Now let us calculate the risk neutral probability. What is the formula for the risk neutral probability? For that we need the time step, which is nothing but small h, which is equal to the time of the option divided by number of steps, that is 0.5. And the formula for the risk neutral probability is e to the power of RH minus d divided by u minus d. So when we substitute this value R 0.04, that is risk free interest rate, into h, we have calculated h as 0.5 years here, minus d 0.9 divided by u minus d 1.1 minus 0.2, you get the probability, that is the risk neutral probability as 0.6. So p is 0.6 and 1 minus p will be obviously 0.4. Now we can calculate the terminal payoff. What is the formula for terminal payoff? The terminal payoff is max of, since it is a put option, we are taking k minus S22. What is k? The strike price is 95, minus S22 is 121. So 95 minus 121 will be a negative value. So the terminal value of the option will be 0. Similarly, at S21, it is max of 95 minus 99. 95 is the strike price, minus 99. 99 is S21. Here also the option price will be 0, because the price of the stock is greater than the strike price. Hence, obviously, the value of the option will be 0 or worthless. But at this particular point, since the value of the stock price 81 is less than the barrier value of 90, so this option gets knocked out here. Okay, so This is how we have calculated. Now let us see how things work out now. We have to calculate now P11 and P10. It is quite obvious the continuation value at P11 and P10 we can. P11 is nothing but E minus 0.04 into 0.05 into what is 0.6? It is the P probability, that is risk neutral probability, into the value of P22 is 0 less 1 minus P is 0.4 into value of P21, it is not 22, it is P21 is equal to 0. So the value of P11 is obviously 0, is equal to 1. This is the 1. So node 1, that is S11 with S10. See, here we have calculated the value of P11 here, right? So the value of P11 is 0. But however, the value of this option P10 will be equal to 0 because the value of S10 is 90, which is equal to the barrier value of 90. So here the option gets knocked out, or the option becomes worthless. So finally at t is equal to 0, the initial option price will be 0. Why it has happened? Why the option price is 0? Because at any point of time, since we have considered an European put option, either the price is greater than the strike price. See, 121 is greater than the strike price of 95. Here at this node S21, 99 is greater than the strike price 95. And here, even though if it is 81, it is less than the barrier price of 90. So the barrier price has been set to 90. So the option gets knocked out here. So at all these places, the option goes worthless. Similarly here, S11, that is the stock price at this node, is 110, which is greater than the strike price of an European put option of 95. Hence, the option value will be 0. Here at S10, the stock price is 90, which is equal to the barrier value. Hence, the option gets knocked out. So, here also, the initial stock price is 100, which is greater than the strike price of 95 for a European put option. So the value of the option has to be 0, obviously, because the option has to expire worthless at that particular point of time. So this is what the analysis says. In this specific example, the knockout put option has a value of 0 because all possible paths either touch the barrier or end with a stock price above the strike price. Here 121 and 99 are the stock price which is greater than the strike price of 95, and S20 is 81, which is the value less than the barrier price. Similarly, here at this node, first stage, the S11 is 110, which is the stock price is greater than the strike price of 95, and here S10 is 90, where the stock price is equal to the barrier price. Here also at the start, S0 is 100, where it is greater, the stock price is greater than the strike price of 95. So this is how we are going to analyze the option using the binomial tree. Let us take the next example. Price a European put option with the following parameters. And stock price S0 is 100. So we have to understand stock price is 100. Now the volatility has been given sigma as 20%. Instead of giving U and D value, they have given the value of the volatility. So based on the value of the volatility, we can calculate the value of U and D. This volatility is nothing but the implied volatility of the stock, which is nothing but the volatility implied by the stock through historical price movements. So continuous dividend yield has been given, which is 3%. So, and risk-free interest rate is 6%, quite high. See, the risk-free interest rate is quite high. Now, the dividend yield will get reduced from the risk-free interest rate while calculating the risk-neutral probability. So, time to expiration is 0.75 years and the number of period N is equal to 3. The strike price K is 95. So, we have to calculate the value of U and D. So, what are we going to do? We are going to calculate the value of U and D using the volatility based parameter, that is the sigma, and we are using the continuous dividend yield, which will get deducted from the risk-free interest rate of 6%. So now we will calculate the CRR parameter. What is the time step h, which is equal to capital T by small n, which is 0.75 divided by 3, which is equal to 0.25 years. So using the CR formula, what is the formula for u? That is the upmove, e to the power of sigma into square root of small h, which is nothing but e into 0.2 into square root of 0.25. So the value of the up move comes to 1.105, and the value of the down move as per the CRR formula is e to the power of minus sigma into square root of h, which is equal to 0.905. Now we have the value of u, we have the value of d, we have the risk-free interest rate, we know capital T, which is 0.75. So we can easily calculate the risk neutral probability with dividends, and we know the dividend yield is 3%. So what is the formula? The formula for the risk neutral probability P is e to the power of r minus delta into h minus d by u minus d, which is nothing but probability P is 0.5125. Now let us see the how to build the binomial tree. Here there is 3 steps, so you will get 4 terminal prices of the stock. So let us calculate and analyze how to do that. So the initial stock price is 100. So the up move is 1.105. So you multiply 100 into 1.105 to get 110.5. And similarly, this is S11 node. And S22 node, how do you get? You multiply 100 2 times with 100 into 1.105 into 1.105, you get 122.1. And finally, S33, how are you going to get? You are going to multiply 122.1 with 1.105 to get the value of S33 as 134.9. So in order to get S33, you are going to multiply 100 with 1.105 3 times, 1, 2 and 3 to get 134.9. Now let us take S10. What are you going to do? We know the down value D is 0.905. Just multiply 100 with this, you get 90.5. Now this node has a probability of moving up by 1.105 and moving down by 0.905. So the value of S21 will be 100 and S value of S20 will be 90.5 into 0.905, which comes to 81.9. We will get the value of 100 from here also, 110, that is S11 110.5. This has got, it can move either up by 1.105 to get 122.1, or it can come down by 0.905 to get 100. So if you multiply 110.5 by 0.905, you will get the same value, 100. Here S22 we have calculated, it has gone up. If it goes up, you get 134.9, but if it goes down by 0.905, then you get the value of S32 as 110.5. This node S21 can either go up by 1.105. So when you multiply 100 by 1.105, you get the same value of 110.5. And if this 21 goes down, then we have to multiply 100 by 0.905. So the value of S31 will be 90.5. Now this node S20 can either go up or go down. See, if it goes up, you will come to the same value as 90.5. But if it goes down, it comes to the value of 74.11. That is what we have built here. Okay, now we will calculate we know the terminal stock prices. So now we will calculate the terminal put option values. So since we are considering an European put option, so if we want to know the put option price here, it is max of strike price minus S33 comma 0. So max of, what is the strike price? 95 minus 134.9 is S33 is 134.9 comma 0. So the maximum of these two is, since this becomes 95 minus 134 becomes negative, the value becomes 0. So the option is worthless at if the stock price is 134.9 because the stock price is higher than the strike price. Similarly, at this point S32, the option value will be 0 because the value, the stock price of 110.5 is higher than the strike price of 95. So here what are we going? P32 is max of 95 minus 110.5 comma 0. Out of this, since 95 minus 110.5 will be a negative value, we will get 0. So at S32 also the option value will be 0. But at SP31 it is max of 95 minus 90.5. Since here the stock price is less than the strike price of 95, you get an option price of 4.5. So the option may fetch you 4.5 if the strike price, if the stock price at S31 90.5 is less than the strike price of 95. So P30 is nothing but max of 95 minus 74.11. So if the stock price goes down from 100 rupees to 74.1, the option put holder will make a money of 20.88 rupees because max of 95 minus 74.11 comma 0 will be 20.88. Now we have to do the backward induction for this European put option. Let us see. See, since the option values at S33 and S32 are 0, so the value at FP22 will also be 0 if we use the continuation formula. What is the continuation formula? P22 is equal to e to the power of minus 0.06 into 0.25. 0.06 is the risk-free interest rate and 0.25 is small h, okay, which is 0.75 divided by 3 since we have taken a 3-step binomial tree. We know the risk neutral probability is 0.5125. So 0.5125 into this value, option value 0, plus 1 minus p, that is 1 minus 0.5125 is 0.4875 into 0. So the option value here also is 0 because the stock price of 122.1 is greater than the strike price of 95. Similarly, here at S21, so what is happening? At P21, it is E minus 0.06 into 0.25. So 0.5125 into 0 plus 0.4875 into 4.5. This value will come here. So the option value here will be 2.2 rupees. Here the stock price of 100 is greater than the strike price, but still the option has got some value because the option has a probability of going down to 90.5 at a later stage. That is why this option is still having some value. Now coming to 81.9, here at P20, e to the power of minus 0.06 into 0.25 into 0.5125 into 4.6 plus 0.4875 into 20.88. They are put it as 21 here. So you get a value of P20 as 12.37. So here also the stock price 81.9 is less than the strike price, and since it is a put option, so here the option value is very high at 12.37. Now we have to calculate the values at the first stage, that is S11 and S10. We know the value P22 and we know the value P21. We multiply P22, that is 0 with P, and 2.22 with 1 minus P, and multiply it with the E minus 0.06 into 0.25 to get the value of the option P11 as 1.07 and the value of the option P10 as 7.14. Here what are we going to do? You are multiplying 2.22 with 0.5125 and 12.37 with 0.4875 and multiplying the whole value by E minus 0.06 into 0.25 to get an option value of 7.14. And finally at t is equal to 0, the option has a value of 3.97. So after you adjust for discounting of the dividend yield, the European put option price is 3.97. So what is happening here? The dividend yield increases the put option value compared to a non-dividend case, because dividend yield reduces the growth rate of the stock. So once the growth rate of the stock is reduced, the put option will more likely to be in the money, as a result of which the price of the European put option here is 3.97. Let us take another example. Price an American put option with the following parameters. The current stock price 90, up factor 1.15, down factor 0.85, risk-free interest 5%, time to expiration 1 year, strike price 95, number of periods 3. So American put option, what are the characteristics? We have already discussed. American put option has a facility for early exercise in case the option is deep in the money. Okay, so whenever it is deep in the money, you can exercise it. You can exercise early when the interest rates, that is risk-free interest rates, are higher, and the possibility of early exercise generally makes American puts more valuable than the European counterparts. So usually American put options are more valuable whenever they are deep in the money or when the interest rates are higher. Now, let us take straight away the tree. Since it is a binomial tree with 3 steps, so the terminal stock prices you will get is 4 terminal stock prices. So the initial stock price is 90. So at the first node S11, you multiply it by 1.15 to get 103.5 as the stock price at the initial node here. This node can either move up or move down. So if it moves up, we multiply 103.5 with 1.15 to get 119. And if it moves down, we multiply 103.85 with D, that is 0.85, to get S21, which is 87.9. Here, this S22 has again probability of moving up by 1.15. So you get S33 as 136.8. And this 119 has a probability of moving down with D 0.85. So S32 value will be 101.85. Now coming to this node, S21 has a probability of going up by 1.15. So if you multiply 87.9 by 1.15, you will get the same value, 101.85. And 87.9 has a probability of going down. So if you multiply 87.9 with the value of D, which is 0.85, you get S31 as 74.77. Now coming to this node, S10 present value is 76.5 as per the calculation. So this can move up by 1.15. So 76.5 into this will give you 87.9, or 76.5 can go down by a value D, which is equal to 0.85. So 76.5 into 0.85 will give you S20 value as 65. Now 65 can either go up by 1.15. So if you multiply 65 with 1.15, you get 74.77, or 65 can go down by a value D. So 65 into 0.85 will give you S30 as 55.2. So this is what we have calculated here using the binomial tree. Now the risk neutral probability is e to the power of RH minus D by U minus D, same formula, and you get it as 0.556. Now we have built the stock price tree, which I am not going to explain because I have explained here in the tree. It is shown here, the calculation has been shown here. Okay. Now we will have to calculate the terminal option value. So what is how do you get the terminal option value? It is max of, since it is a put option, max of strike price minus S33, 0. Since strike price, what is the strike price here? Strike price is 95. So 95 minus 136.8 will be a negative value. So the max of negative value and 0 will be 0. Hence the terminal value of the option will be 0. You can easily see that 136.8, the stock price, is less than the strike we know that the value of S33, which is 136.8, is higher than the strike price. Obviously, this option is going to, expire worthless. Here also, the value of 101.85 is greater than 95, and since we are considering a put option, since the stock price is greater than the strike price, the option is going to go worthless. Hence, the value of the option price will be 0. But here at S31, the value of the stock price is 74.77, which is less than the strike price of 95. So, max of 95 minus 74.77 comma 0 is 20.3. So, if the stock price comes down to 74.77, the option price will be 20 rupees 30 paise. That is what it's been shown here. Okay. Now, finally, P30 is what? P30 is 95 minus 55.2 comma 0 max. So, the max of 95 minus 55.2 is 39.7. So, 39.7 will be the price of the option if the stock price ends at 55.2. Now, we have to do the backward induction formula to get the value of S22, S21, S20, S11 and S10. So, what are the backward induction values? We will do it in the next slide. Now, so at T is equal to 2, okay, this node, continuation value is 0 because these two, since these two are 0, the continuation formula is e to the power of minus 0.05 into 0.333 into 0.556. That is the risk neutral probability into P330 plus 1 minus P, that is 1 minus 0.556 into P32, which is again equal to 0. Hence, P22 will be 0 here. Now, here we have to calculate the exercise option also, early exercise option also. What is the early exercise formula? It is max of 95 minus 119 comma 0. Since 95 minus 119 is a negative value, even if you want to exercise early using the American option, the value of the option will be worthless because this value of the stock price 119 is greater than the strike price of 95. So it is expiry, it is out of the money option. Hence P22 will remain 0. Now coming to S2188. So at P21 with S21 is 88, the continuation value is 8 rupees 80 paisa. Same formula, e to the power of minus 0.05 into 0.333 into 0.556 into 0 plus 0.44 into 20.3. So the continuation value of the option will be 8.8, whereas if we take the max value, that is the early exercise value, so the early exercise value is max of 95 minus the 88 here comma 0, it becomes 7. So here at this particular node, it makes no sense to exercise early, because if you exercise early, you will get only 7 rupees. But if you keep the option, you may get 8.8 or you may get 20.3 also. So it makes sense not to exercise early at this particular node. Now let us come to this node S20. So with P21 we have done. Now with P20, the value of the continuation value is 28.7 using the formula, whereas if you want to exercise early, it becomes 95 minus 65 comma 0, that is the max of 95 minus 65 comma 0. So the exercise value will be equal to 30. So P20 is 30 as of now. So at this node S20, since the continuation value is less than the early exercise value of 30, it makes sense to exercise the option early in case this the stock price becomes 65 at any point of time during the option contract life. Now coming to the first node here, okay, at t is equal to 1, S10 let us consider. So S10, what the continuation value of S10 is 17.9, whereas the exercise value is 18.5. So at this particular node, whenever the stock price is 76.5, which is much less than the strike price of 95, early exercise makes sense, because early exercise will give you 18.5 rupees for the option, whereas the continuation value will give only 17.9. Now let us consider the node S11. Here in S11, the continuation value using the formula is 3.84. So this one should be 3.84. This is not 0. This has to be interchanged. So here the continuation value is 3 rupees 84 paisa. So the option has got still some value in spite of the stock price being higher than the strike price in a put option, because of the time decade. So the option has got still some time to expire, as a result of which the option is still holding some continuation value of 3 rupees 84 paisa. But however, if you try to exercise the option here at S11, since the stock price of 103.5 is greater than the strike price K, which is 95, hence the exercise value will be equal to 0. So of early exercise will give you 0 rupees, whereas since the option has got some time left, so the continuation value of the option is 3.84. Please correct this. This 3.84 should come here in the orange color, and this 0 should come here in the yellow color. At t is equal to 0, the continuation value using the formula e to the power of minus 0.05 into 0.333 into 0.556, this is the risk neutral probability, into 3.84, the continuation value, plus 0.444 into 18.5, this is the exercise value. We are taking, because at this node we are taking the higher of the exercise value and the continuation value, so that's why we consider here as 18.5, not 17.9. Okay. Similarly, when we calculated the continuation value of this, we used 30 instead of 28.7, because we have to take the higher of the exercise value and the continuation value for the previous node. So here what did we do? Here what have we taken? See, you can see the continuation value is 0.5, that is this particular node. Okay, 0 node. Here the continuation value for the up move is 3.84, and whereas here the for the downward move, the continuation value is 17.9, but the exercise value, early exercise value, is 18.5. So we have to consider the early exercise value, which is higher than the continuation value. That is what we have done here. So the value of the option at P00 will be 10.17 continuation value, whereas the early exercise value is very simple, 95 minus 90 comma 0. So the early exercise value will be 5. So at the start of the contract, the option has a price of 10.17, that is the continuation value, whereas the early exercise value has got only 5. So we consider the higher of these two, so the value of the option is 10.17. So this is how we calculate the value of the option using the binomial tree. In the next lesson, we will understand cost of capital and capital structure theories.